Before the federal dollar, how tobacco, wampum, and wildcat banking replaced the currency America couldn't have. Most people think the real problem in colonial America was that there was no money. That's what every textbook tells you. But I'm going to show you something far stranger today. Something that changes how we understand power, trust, and how economies actually function. Stay with me, because by the end of this video, you'll understand that the real crisis wasn't the absence of currency. It was something much more terrifying, the question of who got to decide what counted as money in the first place. And that answer determined who controlled entire colonies. If you've been following this channel, you know how the story usually goes. Colonists needed a medium of exchange, so they used tobacco or wampum or whatever commodity was nearby. But nobody ever asks the question that actually matters. Who got to define what was money, and what did that power mean? If you're new here, subscribe so you don't miss the deeper investigations into how American institutions were actually built. And I genuinely love to hear in the comments what commodity or credit system you think worked best in pre-industrial economies. There's real debate there. Wait, this part is important, and I need your full attention for a moment. The mechanisms that allowed colonists to actually control their own monetary destiny are explained in breathtaking detail in our complete guide, available in the description and in the pinned comment below. It's where you'll find the actual legislative decisions, the private merchant networks, and the accounting tricks that let ordinary people circumvent crown authority. This is the paid guide that unlocks those signals and patterns. Now, let me show you what most histories miss entirely. Here's what happened. The British Crown understood something that modern economists often overlook. Whoever controls the definition of money controls the entire social order. It's not just about commerce, it's about obedience. When you force a colony to use only the currency you mint, you're doing three things at once. You're preventing them from building independent wealth. You're ensuring they remain dependent on your goods and your trade networks. And you're maintaining a system where the Crown's authority is literally inscribed into every transaction. Every coin stamped with the king's face is a reminder that power flows downward, from London into the colonial soil. But the colonists discovered something the Crown didn't anticipate. The prohibition on creating their own currency forced them to become creative in ways that ultimately gave them more autonomy than the Crown intended. When you prevent someone from using official money, you don't eliminate commerce. You eliminate the Crown's ability to monitor and control it. And that's the first secret I promised you would understand by the end of this video. The prohibition became the very thing that freed colonial economies from British oversight. Virginia understood this faster than anywhere else. The tobacco colony didn't just accept tobacco as money out of desperation. The Virginia House of Burgesses, the colonial assembly, made an explicit, calculated decision to weaponize agricultural commodity as currency. In 1619, just 12 years after Jamestown was founded, they passed legislation making tobacco legal tender for all debts, both public and private. This wasn't improvisation, this was policy, and it was radical for a specific reason. It meant that the people who controlled the largest tobacco harvests, the planter elite, could essentially control the entire monetary supply of the colony. Think about what that means. In England, the Crown mints coins and controls the money supply, which means the Crown has leverage over everybody: merchants, lords, commoners, all of it. The British monarchy could expand or contract the currency, and entire fortunes rose or fell based on those decisions. That power was absolute. But in Virginia, the planter class figured out how to achieve something similar without needing Crown permission. They made tobacco the money, which meant they controlled the supply of tobacco, which meant they controlled the money supply, which meant they controlled the colony. The Crown didn't even realize what had happened until decades later. Instead of one monarch controlling currency across the ocean, you had 50 planter families controlling it on the ground. It was a brilliant theft of monetary power disguised as agricultural necessity. The system worked, for a while. Planters could pay taxes, settle debts, and conduct business entirely in tobacco. Foreign merchants trading with Virginia would accept it because they knew they could sell it back in London or in the Caribbean for actual silver. Tobacco was essentially a promissory note backed by real commodity value. But here's where it gets complicated, and this is where the story diverges from what you've probably heard before. The success of the tobacco standard didn't come from the commodity itself. It came from the iron-fisted control that Virginia's planter oligarchy maintained over the supply. And when that control started to slip, everything collapsed. By the 1660s, Virginia had a problem. Too much tobacco was being produced. Not just in Virginia, but in Maryland, North Carolina, everywhere. The commodity that was supposed to hold stable value was flooding the market. Prices collapsed, and when the supply of your money suddenly quintuples in a decade, the people holding that money discover their wealth has evaporated. It's inflation, but it's the kind of inflation that the planter class couldn't hide from or explain away. And suddenly, Ordinary farmers and merchants who'd been operating under the assumption that their tobacco holdings were as good as silver found themselves holding what amounted to paper of rapidly declining worth. The Virginia Assembly did what every government in crisis does. They tried to legislate their way out of it. They passed laws limiting tobacco production. They required colonists to bring their tobacco to official warehouses for inspection and standardization. They even created a system of warehouse receipts, which were pieces of paper that represented a certain quantity of standardized tobacco held in storage. And here's where something absolutely crucial happened, something that barely anyone mentions in the standard histories. Those warehouse receipts became more valuable than the tobacco itself. Because the receipts were standardized, inspected, and limited in quantity, they started circulating as currency in their own right. People stopped wanting to carry around actual tobacco. It was bulky, it spoiled, it was inconvenient. They wanted the papers that represented it. What Virginia had accidentally invented was the first American paper money system. Not because anyone planned it that way, but because a commodity currency had failed and the attempt to fix it created something new. These warehouse receipts were private currency, issued not by the crown and not by the colonial government, but by private warehouse operators, the men who controlled the storage facilities. And here's the dangerous part that made the crown absolutely furious when they finally understood what was happening. This system gave the colonial planter elite even more control over the money supply than the tobacco standard itself ever did. They could now control not just production, but storage, inspection, and certification. They could issue receipts more freely than the commodity itself could be produced. They were essentially creating money out of nothing, or at least out of the promise of future tobacco. This is the moment where American monetary history takes a turn that almost nobody recognizes. The colonists didn't just solve their currency problem, they solved it in a way that opened the door to something that would later be called fractional reserve banking. They created a monetary system where the amount of circulating currency could exceed the amount of underlying commodity. And they did it not through sophisticated economic theory, but through the simple expedient of trying to stop their money from becoming worthless. The real danger emerged when confidence in those warehouse receipts started to wobble. If you're holding a piece of paper that says a certain amount of tobacco is stored in a warehouse in Williamsburg, your entire fortune depends on two things: that the tobacco is actually there, and that the warehouse keeper is honest. One of those assumptions failed regularly. Warehouse operators would issue more receipts than they had actual tobacco in storage. Warehouses would catch fire, destroying the commodity but not the receipts. Dishonest keepers would simply abscond with the goods and the money, and suddenly, you're holding a receipt for tobacco that doesn't exist, and you have no recourse. This is where the parallel to modern financial crises becomes absolutely uncanny. Colonial Virginia had just invented something that would eventually plague every monetary system on Earth: the fundamental problem of trust. When your currency is backed by commodity, trust is still essential, but it's trust in a physical thing. You can inspect the silver coin, you can verify its weight, but when your currency is a receipt, trust becomes abstract. It's trust in a piece of paper, trust in an institution, trust in the promise that something you can't see or touch is actually sitting in a warehouse somewhere. And that's when the real innovators started to emerge. Because if receipts could work for tobacco, why couldn't they work for something else entirely? That's where we need to pause and reset, because the next chapter involves merchants figuring out that they didn't need any commodity at all. The guide linked below, the one in the description and the pinned comment, goes into extraordinary depth on how private credit networks started operating almost entirely independent of physical goods. This is where the real secrets are, where you'll understand the precise mechanisms colonial merchants used to create and enforce private currencies without anyone noticing. What happened next was the birth of something that would eventually reshape American finance entirely: the rise of the private credit note, the forerunner of modern banking. And this is where we leave the world of tangible commodities behind. By the early 1700s, merchants in Boston, Philadelphia, and New York had begun doing something radical. They stopped waiting for crops to arrive or for commodities to be produced. Instead, they issued their own paper notes, essentially IOUs backed by nothing but their own reputation and the promise of future payment. These weren't government documents. These weren't officially sanctioned by any colonial assembly. They were private instruments created by individual men who had enough social standing and commercial credibility that their neighbors would accept their word. A Boston merchant named John Hancock, yes, that Hancock, the one whose signature would eventually become famous, his family was among the first to use this technique on a massive scale. They would promise to pay a certain amount in silver or tobacco at a future date, and merchants throughout the colony would accept those notes immediately, trading them hand to hand like currency. The genius of this system was profound. It solved the chronic shortage of circulating money without requiring anyone's permission. No colonial governor had to approve it, no British official had to sign off. Private men simply created value through their credibility. But this created a problem almost immediately. If merchants could issue their own notes based on reputation alone, then what happened when a merchant lost his reputation? Or when he died? Or worse, when he deliberately tried to cheat the system? By the 1720s, colonial towns began filling with counterfeit and fraudulent notes. Unscrupulous men would forge the signatures of established merchants, flooding the market with false credit instruments. Other men would issue notes far beyond what their actual assets could cover, essentially running Ponzi schemes on a local level. The Massachusetts Bay Colony experienced a particularly severe crisis in this period. Merchants who had built their entire livelihood on the trustworthiness of their notes suddenly found themselves holding worthless paper. The damage to commerce was immediate and severe. This is when something crucial happened, something that most American history textbooks completely skip over. Faced with this crisis, Massachusetts did something that would echo through the next 2 centuries of American financial history. In 1690, they became the first English-speaking jurisdiction in the world to officially issue government-backed paper money. Not because they wanted to, but because they had no choice. Wait, before we move forward, I need you to understand something fundamental here. The pattern you're seeing right now, the way Massachusetts responded to a private credit crisis by creating government currency, this exact pattern would repeat itself over and over across the American colonies for the next 70 years. And later, this same pattern would determine the entire structure of American banking, taxation, and monetary policy right up to the 20th century. If you want to understand how that chain reaction actually worked, how it connected to federal power and to the hidden architects who built our financial system, the guide in the description, the complete analysis of colonial monetary networks and how they scaled into national policy, is where those connections are fully explained. It's a paid resource, and it contains the framework you need to see the machinery behind all of this. The story of that first Massachusetts note is almost comic in its desperation. The colonial government needed to pay soldiers who had just returned from a military campaign in Canada. They had no specie, no hard coins, in the colonial treasury. They couldn't borrow from England because England was hostile to any financial independence in the colonies, so the governor and the general court made a decision. They would print paper. The notes promised that the holder could redeem them for tax payments or for goods from the colonial government at a future date. It was a stopgap measure. It was supposed to be temporary. It worked so well that it never went away. What happened was almost alchemical. Soldiers and merchants who had accepted these notes out of desperation began to realize something remarkable. The notes were more convenient than coins. They didn't weigh much, they weren't subject to clipping, a common fraud where people would shave off the edges of silver coins and pass them at full value. The notes were durable enough if you handled them carefully, and they represented value in a way that was instantly understood. More importantly, they circulated. One person would spend them, the next person would accept them, and suddenly Massachusetts had created something that looked and functioned like actual money. Other colonies noticed. Connecticut followed in 1709. North Carolina in 1712, New York in 1709. Each colony discovered the same thing. A government that could control the money supply could solve its fiscal problems without raising taxes. A government could fund its military, pay its officials, and finance infrastructure, all by simply deciding to print notes and declaring them legal tender. It was intoxicating, and it was, though no one would use the word then, deeply inflationary. By the 1730s and 1740s, most of the mainland colonies had issued paper money. Some, like North Carolina, went completely overboard. They printed so much currency that the value collapsed. A pound in North Carolina paper might be worth only 10 shillings in specie by the time a few years had passed. British merchants and British creditors were furious. They were being paid with worthless paper. Parliament was furious. The British Crown was furious. And that anger would eventually produce one of the most important pieces of legislation in colonial history, the Currency Acts. The first Currency Act came in 1751. It was designed specifically to control what colonists could do with their own money. Parliament declared that paper currency could no longer be used as legal tender for private debts, only for public taxes. This meant merchants couldn't use it to pay each other. It meant wage workers couldn't use it. It meant the circulation of paper money as everyday currency was effectively criminalized. The law was an economic catastrophe for the colonies. Commerce froze, credit dried up, prices on imported goods skyrocketed because merchants had to demand specie, which was always scarce. The decision to import goods fell, taxes went unpaid, and the colonial governments faced genuine financial crisis. And here's where the narrative takes a turn that hardly anyone knows about. Because the colonists didn't accept this, they found a way around it. What happened over the next 20 years was a financial innovation born of pure necessity. If the government couldn't issue paper money legally, then private men would do it instead, but not the merchants anymore. This time it was someone new. It was the land speculators, the plantation owners, the men who controlled large properties and held significant debts. They created what were called land banks or loan offices. These institutions would issue paper notes backed by the value of land rather than by government decree. A man with a large estate could put up his land as collateral, receive notes from the land bank, and use those notes to pay his debts or make purchases. The notes would circulate and theoretically, the value was secured by real property. It was a clever workaround of the Currency Act. The law said the government couldn't issue fiat currency, so private institutions did it instead. The British authorities absolutely hated this. They saw it immediately as a way to evade the Currency Act. By 1773, just 3 years before the Revolution would begin, Parliament passed a second Currency Act that even prohibited the colonies from creating these land banks. But by that time, it was too late. The damage to British colonial relations was already done. Americans had learned something fundamental about monetary power. They had learned that when the government wouldn't provide money, people would create it themselves. They had learned that the right to issue currency was in fact the right to control the economy. And that knowledge would inform every argument about money and power that came after the Revolution. When the Founding Fathers sat down to write the Constitution, they made sure that the federal government, not the states, not private banks, but the federal government, had the exclusive right to coin money and to regulate its value. That single clause, buried in Article 1, Section 8, wasn't just a technical provision. It was a response to a century of chaos. It was an attempt to prevent wildcat banking, to prevent states from doing what the colonies had done with their paper currency schemes, and to ensure that American money would be standardized and controlled from the center. But here's the thing about that intention. It never actually worked the way the founders imagined, because the same forces that had driven colonists to create their own currency in the first place didn't disappear just because a new nation had been founded. In fact, they got worse. The United States in 1800 was not a unified financial system. It was a patchwork. A farmer in Ohio couldn't easily trade with a merchant in New York. A businessman in Philadelphia couldn't trust the currency of a bank in Charleston. And here's why. The Constitution had given Congress the power to coin money, yes, but it had said nothing about whether states could issue their own banknotes. It had said nothing about whether private banks could print their own currency and put it into circulation. And it had said nothing about what happened when you had hundreds of different paper currencies, each backed by different institutions, each worth different amounts depending on where you were standing. So, what emerged was something the founders had not anticipated. Not a central banking system, not even a stable national currency. Instead, there was an explosion of private banks, each one essentially printing its own money. These were called state-chartered banks, and by 1820 there were over 300 of them. By 1860 there were more than 1,000. Some were legitimate institutions run by careful men who kept adequate reserves. Others were essentially confident schemes designed to make their founders rich before vanishing into the night. A bank in Maine might issue a note worth $1, but if you tried to redeem that note in Boston, the banker there might say it was worth 90 cents, or 50 cents, or nothing at all, depending on his assessment of Maine's economy and his trust in that particular bank. The note itself became an object of speculation. Imagine going to a store with a handful of currency and the shopkeeper having to consult a thick reference book to see which notes were legitimate and which were counterfeits or issued by banks that had already failed. This book actually existed. It was called the Banknote Reporter, or sometimes just the Counterfeit Detector, and it was constantly out of date. By the time a new edition was printed, new banks had been chartered, new counterfeits had appeared, and old banks had failed. A businessman couldn't actually conduct trade with confidence. He couldn't know if the money in his pocket would be worth anything in the next town. This wasn't theoretical economic instability. This was the actual texture of commercial life in early 19th century America. And so we encounter one of the most important figures in the history of American finance, a man whose name is almost entirely forgotten, but whose actions shaped the entire banking system that would eventually give birth to the Federal Reserve. His name was Nicholas Biddle, and he was the president of the Second Bank of the United States. Now, the Second Bank of the United States needs context. The First Bank of the United States, chartered in 1791 and championed by Alexander Hamilton, had been allowed to expire in 1811. For 5 years, the nation had no central bank at all. The War of 1812 exposed the catastrophic consequences of that absence. The government couldn't finance its own military because there was no stable institution capable of managing the nation's credit. So, in 1816, Congress chartered the Second Bank of the United States. another private corporation with a federal charter and significant government deposits. It was meant to bring order to the chaos of state banks and their wildcat currency. Nicholas Biddle took over as president of this bank in 1823, and what he attempted was something genuinely revolutionary for the time. He tried to use the second bank's power, its size, its federal charter, its ability to hold deposits from state banks, to impose discipline on the entire banking system. Here's how it worked. When a state bank issued notes and those notes ended up in the hands of the second bank, Biddle would present them for redemption. He would demand that the state bank pay him in specie, in actual gold or silver coins. If a state bank couldn't do that, it meant the bank had issued more notes than it had backing for. It meant the bank was essentially committing fraud. So Biddle's strategy was to starve out the fraudulent banks. He would accumulate their notes, then suddenly demand redemption, forcing them to either cover their obligations or collapse. It was a brilliant, ruthless strategy. And it actually worked, to some degree. Biddle did manage to reduce the number of wildcat banks. He did manage to create a more orderly currency. But, and this is crucial, he did it through the exercise of raw financial power by a private institution. The second bank wasn't accountable to voters. It wasn't truly accountable to Congress. It was accountable to its shareholders, who profited handsomely from Biddle's discipline and his decisions. And this is where we need to pause for just a moment. Before we continue, I need you to hold this in your mind. The fundamental tension between order and freedom. Because what Biddle was doing was creating stability, yes, but he was doing it by concentrating enormous power in the hands of a private banker. And the question that was about to tear American politics apart was this: who should have the authority to control the money supply? Should it be a private bank, however well-intentioned? Should it be Congress? Should it be the president? Should it be the states themselves? This is precisely where my complete guide on the hidden architects behind American banking becomes essential. In the description and the pinned comment below, you'll find an in-depth examination of how men like Biddle operated behind the scenes, the specific mechanisms they used to consolidate financial power, and the networks of influence that connected bankers, politicians, and industrialists. This guide goes far deeper than I can here into the personalities, the letters, the backroom dealings that shaped American monetary policy for more than a century. If you want to understand not just what happened, but why it happened, and how it was actually orchestrated, that's where the real keys are. Now, Andrew Jackson knew exactly what Biddle represented. Jackson was elected president in 1828 on a wave of anti-establishment fury. He was a military man, a nationalist, and he viewed the Second Bank of the United States as an aristocratic institution, a private monopoly that served the wealthy at the expense of common people. In his mind, the bank was un-American. It concentrated power in the hands of Eastern elites. It printed paper currency instead of honest gold and silver, and it extracted wealth from ordinary citizens through inflation and financial manipulation. In 1832, Biddle and his supporters made a fatal tactical error. They asked Congress to renew the Second Bank's charter. It wasn't scheduled to expire until 1836, but they wanted to move the vote before the election. They assumed Jackson would veto the recharter bill, and that the veto would be unpopular, and that this unpopularity would cost him the election. Jackson vetoed it, and what he said in that veto is remarkable. He didn't argue about economic theory. He argued about power. He argued that a private institution should not control the money supply of a sovereign nation. He argued that the second bank served the few at the expense of the many. And he argued, explicitly, that the Constitution had granted Congress the power to regulate money, not private bankers. What happened next was political dynamite. Jackson, to everyone's surprise, won the 1832 election decisively. He had framed the election as a battle between the people and the aristocrats, between democracy and oligarchy, and the American people chose Jackson. So, Biddle's bank was doomed. But instead of accepting defeat gracefully, Biddle made a decision that would send shockwaves through the entire American economy. He decided to contract the money supply, he called in loans, he reduced credit to state banks, he drained liquidity from the economy. In other words, facing political defeat, Biddle deliberately created a financial crisis. This wasn't subtle. Biddle essentially said to Congress and the American people, support my bank, or I will destroy your economy. It was the most blatant use of financial coercion by a private institution in American history. And it actually worked, politically in the short term. The economic contraction was severe. Businesses failed, people suffered, and there was massive political pressure on Jackson to back down and accept Biddle's terms. But Jackson refused. He went on the offensive. He ordered that federal deposits be withdrawn from the second bank and transferred to state banks, institutions his allies called pet banks. And in doing so, he essentially killed the Second Bank of the United States. Its charter would expire in 1836, and it would not be renewed. For more than 70 years, the United States would have no central bank at all. And this is when the real chaos began. Without a central bank to regulate the money supply or enforce standards, state-chartered banks multiplied like a virus. By the 1830s, there were more than 300 banks operating across the United States. Each one had the authority to issue its own banknotes. Each one set its own rules. And each one, if it could get away with it, printed far more currency than it actually had in gold reserves to back it up. The result was a financial nightmare that would become known as the era of Wildcat banking. A Wildcat bank was typically a small institution set up in remote locations, places far from major financial centers, far from easy verification, far from regulation. The operator would print banknotes that looked legitimate, circulate them into the surrounding communities, and then disappear before anyone discovered that there was no gold backing them up. The banknotes would end up worthless in the hands of farmers, merchants, and ordinary people who had accepted them in good faith. But Wildcat banking wasn't just about outright fraud. It was also about competitive debasement. Even legitimate banks faced crushing incentives to overissue currency. If Bank A in Pennsylvania issued $10,000 in notes backed by only $5,000 in gold, and those notes circulated successfully, Bank B in Ohio would have to do the same just to keep up. Otherwise, its notes would be worth less, customers would prefer Bank A's currency, and Bank B would lose business. This race to the bottom created a perverse incentive structure. The most conservative banks, the ones that actually kept high reserves and printed cautiously, would be punished by the market. Their notes would trade at a discount. Depositors would withdraw their funds and move them to banks that printed more freely. Financial prudence became a liability. By the 1840s and 1850s, ordinary Americans faced an absurd reality. A farmer in upstate New York might have a wallet containing banknotes from dozens of different banks. Each one had a different value depending on where it was presented. A note from a stable Philadelphia bank might circulate at face value in New York but trade at a 10% discount in Boston. A note from an obscure Michigan bank might be worth 50 cents on the dollar, or nothing at all if the bank had recently failed. This wasn't money. This was a lottery system disguised as currency. Merchants developed entire reference guides called banknote detectors that listed the current value of every bank's currency in circulation. These were thick, updated quarterly or monthly, because banks failed so frequently that the information became obsolete rapidly. A merchant in Cincinnati might need to consult 5 or 6 different detectors before accepting a bundle of notes from a traveling trader. This was the financial system of a major industrial economy in the 19th century. This was what passed for monetary stability in the United States. The counterfeiting epidemic that followed was spectacular. With so many different banks issuing notes, and with so much variation in printing quality, skilled counterfeiters found an almost unlimited opportunity. A good counterfeiter could examine a legitimate note, replicate its design, and produce fakes that were indistinguishable from the real thing. But here was the twist. Even when a counterfeit was discovered, it was often impossible to determine which bank should bear responsibility. If someone had counterfeit notes from the Philadelphia Bank of Commerce, should the Philadelphia Bank of Commerce compensate the victim? Not necessarily. The victim had accepted the notes, they bore the risk. Or did they? The courts weren't sure. The legal framework didn't exist to answer that question clearly. Some counterfeiters became celebrities of a sort. There was a network of operations across the Midwest, skilled printers and engravers who produced counterfeit notes with such quality that they passed through circulation for months before being detected. Law enforcement was largely powerless. There was no federal police force dedicated to counterfeiting, no interstate coordination, no unified system of investigation. A counterfeiter could operate in Ohio, get caught, serve time, and then move to Indiana and start again under a different name. The cumulative effect on the economy was destructive. Businesses couldn't trust the currency they received. Prices became unstable because the actual purchasing power of different notes was unpredictable. Long-term contracts were nearly impossible to negotiate because nobody knew what the agreed-upon payment would actually be worth at settlement. Investment dried up. Economic growth stalled. The instability that had begun with Andrew Jackson's destruction of the second bank evolved into something far worse. Not a shortage of money, but a cascading failure of trust in whatever money did exist. And this is where the story takes a darker turn, because the chaos of Wildcat banking created an opening for a new form of predatory finance that would come to define American banking for the next century. During the 1850s and 1860s, while ordinary businesses and farmers struggled with the instability of Wildcat currency, a new class of financial operators emerged. Money brokers and currency dealers who made their fortunes by exploiting the very chaos that paralyzed the rest of the economy. These were men like Jay Cook and later J.P. Morgan. They positioned themselves as intermediaries between the confusion. They would buy bundles of notes at a discount, sometimes paying only 60 or 70 cents on the dollar for notes that were nominally worth 100, and then sell them at a profit. They became the gatekeepers of currency exchange. If you wanted to move money from one place to another with any confidence, you had to go through them, and they charged for that service. More importantly, these money brokers began to consolidate power. They became the trusted sources of financial information. They published their own price lists for currency exchange. They lobbied state legislatures for favorable regulations, and in doing so, they began the process of building a new financial system, not one based on government control, but on the dominance of private financial institutions that could coordinate with one another and present themselves as the only solution to the chaos. This is the secret I promised you at the beginning of this video. Before the Federal Reserve existed, before a central bank returned to the United States, before Alexander Hamilton's vision was finally realized, private bankers had already begun to create their own shadow central banking system. They did this not through legislation or public debate, but through market dominance, coordination, and the simple fact that the chaos of wildcat banking was so destructive that ordinary people and merchants had no choice but to accept whatever system the brokers offered. The Civil War accelerated this process. When the federal government needed to borrow massive amounts of money to fund the war effort, it went to the private bankers. Jay Cooke coordinated the sale of government bonds. J.P. Morgan and other banking houses became the primary creditors of the United States itself. After the war, when the economy was struggling with Reconstruction, it was these same private bankers who were positioned as the arbiters of financial stability. They had leverage, they had information, they had the resources to move markets, and they used all of it to shape policy in their favor. By the 1890s, when the economy faced its next major crisis, a contraction known as the Panic of 1893, it was J.P. Morgan and a consortium of private bankers who stepped in to resolve it. Not the government, not a central bank. Private bankers acting in concert, using their own resources and their own authority to stabilize the financial system. They did this because they had become, de facto, the central bank. They had filled the vacuum that Andrew Jackson had created when he destroyed the Second Bank of the United States. The irony is almost too perfect. Americans had rejected the Second Bank of the United States because they feared centralized power. They wanted a system where many banks could operate freely, where local control and competition would prevent the abuses of a monopoly. And what they got instead was something far more problematic. A hidden, unelected, unaccountable network of private bankers who wielded central banking power without any of the visibility or constraints that public debate or legislation might have imposed. This is why the Federal Reserve, when it was finally created in 1913, was structured the way it was. The architects of the Fed, men like Paul Warburg and Benjamin Strong, understood that they had a political problem. They could not simply recreate the second bank under a new name, because the American public remembered what had happened the last time. But they could create a system that appeared to be public, a central bank technically owned by the federal government, while maintaining substantial control in the hands of private bankers. The Federal Reserve System is in many ways the legalization and legitimization of the shadow central banking system that J.P. Morgan and his peers had already built. The path from tobacco and wampum to the Federal Reserve was not a straight line toward rational monetary policy. It was a story of power consolidation, of failure and crisis creating opportunities for private interests to expand their control, of democracy being sidestepped not through force but through the creation of technical complexity so dense that ordinary citizens simply could not penetrate it. Every time you use a dollar bill today, you are the beneficiary and the subject of a system that was shaped not by democratic deliberation, but by the behind-the-scenes negotiations of bankers who had learned that power could be exercised more effectively through control of information and finance than through direct political authority. You are using a currency that exists because Andrew Jackson destroyed a bank, which created chaos, which private bankers then exploited to build a new system, which was eventually formalized as the Federal Reserve. Understanding this history is not about condemning anyone or promoting cynicism about financial systems. It is about recognizing that the institutions we take for granted were not inevitable. They were built by specific people making specific choices, often in private, often outside the view of democratic accountability. That recognition changes how you understand your own position within these systems and how you evaluate claims that the current structure is somehow natural or permanent. Here is your challenge for this week. Find one institution in your financial life, your bank, your brokerage, your insurance company, your mortgage lender, and research its actual history. Not the sanitized version on the corporate website, but the actual origins. Who founded it? Who funded it? What financial crises was it involved in? What lobbying has it done? You will almost certainly discover a story far more complex and revealing than you expected. That is exactly how power works. It operates beneath layers of legitimacy and routine until you pull back the surface and look at the actual people and decisions. Thank you for staying with me through this exploration of American monetary history. If this story resonated with you, I would deeply appreciate it if you would subscribe to the channel. It means everything when you hit that bell so you never miss when we uncover the next hidden architect of American power. Please leave a comment below sharing what surprised you most about this history or what institution you decide to research this week. I read every single comment, and your perspective shapes where we go next.